Bismillahirrahmanirrahim. Good morning to all of you. Aha, another session. IFRS 18. Huh? Yellow highlighted. IFRS 18 exam style question number 1. Yes, student. The first agenda of this session is about what if IFRS 18 examined with question number 1. So the picture will be like this, no? Pre-populated sheet. Here the case consolidated income statement, but some adjustment requires for IFRS 18. Very interesting situation. So assume that this is some sort of exhibit and this is unadjusted or drafted consolidated P&L without any adjustment of IFRS 18. We need to incorporate the IFRS 18 adjustment and then redraft the P&L. So let's start the question. Very interesting situation. Whatever we have done with the last sessions, now we need to apply with question number 1. I promise you that I will give you the guidance as max as possible. In fact, all 360 degree. So let's start the session. So quickly read the question. First requirement. Requirement. What's the requirement? Quickly read the requirement. In fact, you need to pause this video and invest 1 minute to read this particular question. Very simple. Now it's your time. Pause the video. Okay, have you done it? Let's start. Requirement. Redraft the consolidated P&L for the year end 31st December X7 in accordance with IFRS 18. That's about operating, investing, financing categories. And maybe something about aggregation or disaggregation matter. Maybe something about labeling matter. And show clearly the correction of errors and adjustments. Then briefly explain the rationale, the justification. Rationale means justification for each adjustment referencing IFRS 18 presentation rules. So examiner can examine with this way. The question I have prepared with the support of AI. So let's start. Below is the draft consolidated P&L. Below means refer to the spreadsheet. That's this one. Oh, sorry. This one. Sorry. Okay. Refer the draft consolidated P&L for Zeta group for the year end 31st December X7. The draft P&L extract, but the additional information. First, we need to refer the draft accounts. This is what the draft accounts. These are the line items, something incomplete, and maybe some errors. It's given the term operating category. Do remember that the main P&L not referring or not incorporate the heading of operating category, financing category, or investing category. Oh, sorry, operating category, investing category, or financing category. Yes, we need to incorporate with the particular categorization rules. But the final shape of the P&L is like this. Mentioning with the mandatory subtotals and optional as well. So exam question, it's not necessary that they mention these headings. I've attached these headings just for support for you people. Okay, so let's read the P&L. Revenue, cost of sales, gross profit, other income. Mention other income. Not not rightly labeled. It's not acceptable. Operating expense. Operating expense. Okay, that's acceptable. But what inside we don't know. Something gap. It's about investing category. Maybe some items need to incorporate. We need to refer the exhibit. Finance category. That's finance cost. Profit before tax. Tax expense. Profit for the year. First of all, you need to refer that. Recall the statement. Recall the statement. Is this something about missing? Is this something about missing? Specifically about the mandatory subtotals? Operating profit? No. No operating profit term here. Number one, missing the operating profit. Mandatory subtotal. Profit before finance and income tax. It's also not mentioned. Profit before income tax. It should be income tax. Income tax. Income. Complete. That's given. And leave it about the profit from continued operation. Profit for the year. So only one subheading that's compulsory requirement, it's available, but two are missings. Okay, that's the first point need to refer here. Okay, now what else? The exhibit says additional information. Interest income misclassification. Included other income, $10 million interest income from cash balance. Number one, other income labeled wrongly. Number two, includes the $35 million, includes the 10 million related to cash balance. This company, it's not mentioned that what particular type of company it is. Examination, definitely examiner will mention you. We will definitely assume that it's other than bank or asset management companies. So it's other than bank or asset management companies. So any interest income from cash or cash equivalent, that should be the part of investing activity. So they have used wrong category. Wrongly used the label, and also 10 million, it's wrongly incorporated with the line item of operating activity. It should be the part of, this should be the part of investing activity. Is this clear? Yes. Number two, share of profit from associated omitted. The group associate earned profit of $8 million and during the year, and this has not been included, nothing in investing category. So we have to incorporate it. Dividend on redeemable preference shares. Dividend on redeemable. That should be the part of the finance cost. Finance team mistakenly omitted $5 million dividend paid on redeemable preference shares, classified as liability. So mistakenly omitted. Okay. So this should be the part of finance cost. Or you can aggregate. That's dividend. It's a discussion. That's dividend can be aggregated or not. If yes, you have to explain that point. For example, the same characteristics point with the nature finance cost. It's not about the process. It's not about the function. It's two cost with the same category can be aggregated. Okay. Interest cost of lease liability. Interest cost of lease liability. Lease liability is not the liability from where the company generate finance. It's other category. Lease liability. Other category of the liabilities, interest cost must be presented with the finance cost. So what they mentioned, operating expense of $60 million include $15 million interest expense on lease liability. What they have done it, interest cost incorporates with the lease liability, that's wrong. That's not right. So what we should do, we have to make adjustments here, some adjustment and redraft it. Further, we have to incorporate the mandatory subtotals as well. Okay, so let's start the thing. Let's start. The number one point, interest income misclassification. That's other income. This other income, that's should be labeled with other operating income. At least you have to mention operating. At least you have to mention operating. Although the term other with the category operating income, this other, it's not liked by IFRS 18, but or not recommended by IFRS 18, but acceptable. But only the other income, it's not acceptable. So other income includes 10 million about the interest income from cash balance. Cash balance. So here we will mention the interest income. Interest income from the cash balance. No need to mention the cash balance. You have to mention 10 here and you need to minus 10 here. Very simple. This is what the interest income, and this is adjustment 1. Yes, this is the first thing you have to, first thing I have done it. I hope that you people are good to know, good to get understanding. It's clear now. So how IFRS 18 matters can affect with question number 1. Okay, further. Come on. Number 2, share of associate profit. They have omitted. Simple, $8 million. No need to make any adjustment from the figures. Just mention share of profit of associate. Okay, the amount is 8 million. It's very simple. By the way, I strongly suggest you need to attempt by yourself. Pause the video here, need to attempt yourself, then continue video. That will be the good exercise. That becomes the good exercise for you if you obey that particular order. Okay. So further, subtotal matter we will conclude after incorporating all adjustment. Don't worry. Dividend on redeemable preference shares, omitted 5 million. So the point is that can we I'm sorry, this share and associate profit, that's we can use the other column, sorry, this one, and we have to mention here associate profit, and this is adjustment 2. Oh, I hope all clear, huh? So 2 adjustment I've done. That's now the next adjustment is about dividend from preference shares. This is adjustment number 3. So where it should be the part of the finance cost. Finance cost, that is 5 billion. So that's the cost now. Cost should be, if it's mentioned the finance cost 25, here also need to add here. So minus minus plus. Actually we are not, we are using the sign minus, but we are adding here in fact. But there is a question, sir, shouldn't be the redeemable dividend as a separate line item or as disaggregation? I suggest no. Over disaggregate information burdenize to the burdenize to the user of the financial statement, like the reference of the bill from the restaurant or detailed bill, the bill number 2. So here, sir, can you explain please, because we have to make an explanation about the aggregation here with the rule of aggregation. So dividend from redeemable preference shares having the same characteristics of other interest cost. For example, on a regular basis, you have to pay that redeem on the regular basis. And there's no volatility. That's consistent cost of redeemable dividends like the other finance cost. So characteristics of the two nature of the transactions, that finance cost and the redeemable dividend, are same. That's very simple. So we can aggregate, but we have to explain that point. Okay, next point. Interest cost of lease liability. Operating cost of 60 million. Operating cost of 60 million. Yes, includes 15 million interest expense. So that should not be the part of operating expense. It's a mistake. So this is adjustment 4. Lease interest. Lease interest, that should be adjusted from there. That's 15. So minus 60, we have to withdraw the amount. So that should be plus. So 60 minus plus 15, automatically 15 withdraw from operating expense, and that should be the part of interest. Yes, finance cost here 15. Same nature, the finance cost. So these are the adjustments. Before finalizing, we have to incorporate the mandatory subtotals as well. Number 1, operating cost. Oh, operating profit. Operating profit, yes, very simple. Operating profit. Number 1, we have to total the operating profit here. Number 1, this will be the operating profit. Don't need to highlight, just for the sake of you people. Further, profit before, that's also mandatory, total before interest and income taxes. Don't use the word only tax. use the word income taxes. That's we will use here. Okay. Then the finance category. Then finance cost here, category finance cost. And after the finance cost, that's right. That is profit before income tax. It's not mandatory, but you can refer here. And then profit, then tax expense here. Yes. And then important point is profit for the year. Okay. Now we have to adjust all the thing. Yes, quick. 420, 280. That's gross profit. Yes, 35 plus this, that's 25. 60 plus this 45. Make a sum from the gross profit this. Yes, come on. That's 120. Then income tax, interest income, sorry, 10. Then this 8 share of profit. And then 120 plus, yes, make it clear, 138. And then finance cost, yes, add, I'm sorry. That's equals to, I'm sorry. 25 minus. All these things need to add. Simple as that. 25 plus 5 plus 15. Sorry. Yes, I'm sorry. 25 plus 5 plus 15. Total negative 45. All these finance costs need to merge. Then 93. Then tax expense and its total. That's 75. This is the profit. Previously, the wrong profit, that was 72. Now we have to report the profit 75 with these subtotals. Here the total profit before income taxes, it's not mandatory. Okay, that's important. So that's a point. That's a pre-populated. That's a practice question where you people have realized that situation, that how the pre-populated matters can be examined. Do remember that it's not compulsory that the question only about IFRS 18. Maybe some more adjustment. For example, adjustment about the pensions and more other aspects, like you people are doing the practice questions. But I know that this question is very much important and it's a push factor. My lecture not only includes about topic, but also includes all aspects of the practice question. This is about the question number 1. Previously, we have already covered this section B type or even section A, ethics with other questions. means ethics question with the other part. It's also possible. So this is a point, but the question it's not yet complete. Huh? Here, whatever the adjustment we have done, we need to explain. By the way, here I've mentioned that this is what about the structure you need to follow. For question number 1, pre-populated draft, make adjustments, errors, rectification of errors, make adjustments, redraft the financial statement, explanation, whatever the explanations you have to link with the IFRS 18. Now one by one. This is about the question. Qadi Saab, Mr. Qazi, take a slide please. Come on. Start the question here. Read it. Very simple. The start point, to correctly present consolidated P&L under IFRS 18, we must adjust for errors in classification and omissions. And I suggest you also have to mention the subtotals as well. You have to mention. Particularly mentions about the subtotals. If the mistake about the subtotals, you have to mention that. Even this question, it's not yet mentioned the subtotals. In fact, the question is not the answer is not complete if there is a mistake about the subtotals and you are not mentioning. Okay. This ensures the operating, investing, financing activities are presented clearly and consistently. One by one. The draft include interest income 10 million. Within other income under operating activity, IFRS 18 requires interest income from cash equivalent to be shown investing category. Same we have done it. Investing category. We adjust the investment income from operating category and in fact rectification of error and incorporate with the investing category. Investing category, not operating. So that operating profit, so that this statement is very important. So the operating profit reflect only the result of the core business operations. Very important statement. Further, the other income label, the label of other income is also not permitted by IAS 1. Instead, other operating income may be used through IFRS 18, discourage its use. You have to mention, even IFRS 18 allow other operating income, but also discourage. Only the other income, it's not allowed. Other, then attach the category, other operating income, other investment income, maybe other finance cost. Okay. Associate inclusion, associate profit. The group share of profit from associate 8 million. Yes, same. And that was omitted from the draft. IFRS 18 requires such income to be presented investment category. Separating from operating performance from return on equity. This ensures faithful representation, conceptual framework, faithful. That means transparent and for users' sake of user, comparability across the entities. Toyota versus Honda, all these things. Dividends, next point, dividend on liability, class shares. Dividend of 5 million redeemable preference shares were not included in the draft. Was omitted. Since these shares are liabilities under IAS 32, dividend represent finance costs. That's not about the IFRS 18. IFRS 18 not declared the dividend of preference shares, redeemable preference shares as finance costs. It's about IAS 32 and must be shown in finance category. First thing is category. Second point, can we aggregate with other finance costs? Here is the answer. For presentation, these evidence may also aggregated with other finance costs. because they have similar characteristics which reduce unnecessary, not overburden, that disaggregation, not overburden. Bill number 2 from the restaurant, that's overburden. Lease liability, interest of 15 million, lease liability was wrongly included in operating expense. Wrongly included. Same, we have adjusted it. Lease, interest on lease, it's not a part of the operating expense. Under IFRS 18, such costs must be shown in the finance category because they arise from funding arrangement rather than day-to-day operations. This reclassification shows users see true cost of finance separately from operating cost. Conclusion. After these adjustments, the profit for the year increased from 72 to 75. Yes, exactly, 72 to 75. Corrected. The corrected presentation fully aligned with IFRS 18. Provide a clear separation between operating, investing, and finance categories. That is the way you need to draft. This draft having a missing point about the subtotal. You have to mention the subtotal as well. Make a heading about the missing the subtotal. Make a reference of IFRS 18 about the compulsory subtotal for operating profit and profit before interest and income tax and profit for the year, where this question missed operating profit and profit before interest and income tax. After the session, I will give you the answer, the same answer, but I will incorporate that heading as well. Huh? Don't worry about that. But you can also write the thing. The answer will be incomplete if you don't mention the mandatory subtotals. That's important. So students, that's what the promise that I have fulfilled. That's I will practice a question about the question number 1. But one more thing. Yes, that's something about yes. What is this? IFRS 18 implications with IAS 7 new rules. Don't worry, not very much extensive. Only 3 points here. Only 3 points. Don't worry about that. Not very much extensive. Don't worry about that. What are the 3 points? What are the 3 points? Number 1, don't mix the income statement presentation and the theme for that, a very comprehensive theme, with cash flow. Although the name having example, operating category of P&L reflect the profit, not the cash flow, profit from the core business operations. Cash flow from operating activity, that is about cash flow from the core activity of the business. So there's a difference than investing and financing as well. The first change of the first implication of the implication that affect to the IAS 7 rules is that first is something about the presentation. What does that mean, sir? Presentation. Number 1, the first thing, if you start making the consolidated cash flow or the simple cash flow, previously sometimes or some companies start profit before tax, some companies start profit before interest and tax. So there was no rule. Now there's a rule. Always start the cash flow from operating activity from cash flow from operating activities. Oh, I'm sorry. Always start the cash flow from operating activity from the operating profit. From the operating profit. And there was a term used, you remember, cash generated from operation. Now the cash generated from operations term replaced by cash flow from operating activities. Cash flow from operating activities. So you start the indirect method from cash flow from make a heading cash flow from operating activity, and the first start with the always with the operating profit. Take out the operating profit. Take out the operating profit of the P&L and make adjustment, non-cash item like all these working capital adjustment, and then close with cash flow from operating activity before income taxes. But sir, what about the interest, dividend paid and taxes? Don't worry, the income taxes payment is a part of cash flow from operating activity. Don't worry about that. But on the other hand, if the company is Toyota, not the bank, not asset management, the rule is fixed. The rule has now become fixed. No more IS1. No more I7 previous presentation. No more flexibility. If Toyota company receive any interest, that's a part of investing activity. Receive any dividend, part of investing activity. It's not option, compulsion. You have to do that. Interest paid, financing activity. Dividend paid, financing activity. Previously, dividend paid, either finance, either operating. No way. It's a fixed rule. No choice. No choice. No choice. Whatever the previous one, that was about, for example, dividend paid, it may be operating or financing. Dividend received is maybe normally the investing, sometime operating. It was not particularly mentioned, but here the rule it's now become particularly specified. It's very clear. Toyota receive any interest, any dividend, park with investing activity of the cash flow. Toyota paid interest or dividend, any cash outflows about the interest or dividend, park with the financing activity. So the rule is very straightforward. It's now become simple, no? But there are some exceptions. But don't worry about that. If I'm referring Toyota, I'm deliberately referring the Toyota, because Toyota here, it's not bank, it's not asset management. Exception only belongs to the companies having defined main business activity. That's banks and the insurance companies. Exception belongs to them, not other than that. So majority of the question it's about other than bank and insurance companies. So the rules are fixed. Interest received, dividend received, investing activity. Interest paid, dividend paid, financing activity. But the exception for banks and insurance company, very simple. The exception is that IFRS 18 implication with IS7 says that banks, banks means providing of finance, that's bank. And investing asset, that's asset management companies or insurance companies. Here a simple rule. The rule is very clear. Interest paid, interest received, dividend paid. Sorry, interest paid, interest received and dividend received according to how they report to P&L. So exception, it's about interest received, interest paid, dividend received, not about the dividend paid. Dividend paid in any case, dividend paid in any case, either Toyota, either bank, either insurance company, dividend paid always with financing activity. So this exception for banks and insurance company, it's about interest paid or received and dividend received. So what the exceptions, sir? What the exceptions? They will report according to the P&L. That's all. If a bank receive interest and report to add P&L report to investment income. So also parallel the cash flow bank reflect the interest received about investing activity. Same for dividend received, same for interest paid. For bank, it's possible the interest received, it's investment income or the operating income as well. If it's customer matters, all these things, that's something different. But it's not, don't involve in much complications. Very simple rule about the bank's insurance company. Whatever they have incorporated according to the P&L rule, whatever we have discussed before about interest received, dividend received, interest paid, that's reflect with the cash flow. But dividend paid must have to park with financing activity. Last point, very simple. Listen this point very carefully. This is not about the bank or like this. Come on. Normal business activity, which is not defined as bank or insurance company. Toyota. Like Toyota. Adjustment for non-cash item. Non-cash item means if you're working with the cash flow, what you will do? Start with the operating profit. Means indirect method. First is heading cash flow from operating activity. Start with operating profit. Now you need to make adjustment now from operating profit. You need to make adjustment. You have to withdraw the non-cash items. Now listen carefully. After the changes, what happened? Listen carefully. The first point, items that do not require adjustment. That do not require adjustment means if the operating, we are going to make adjustment from the operating profit. Adjust like this, non-cash item need to withdraw, or anything which is not the part of the operating have to withdraw. Like depreciation, non-cash item need to withdraw, right? Depreciation. For example, gain or loss on disposal of property that's using for admin purpose. Property for admin purpose, gain or loss for disposal, that's need to withdraw. But quickly, investment property rental income. Answer me. Investment property rental income. Is this a part of the P&L profit? Sorry, is it a part of the P&L operating profit? No. It's a P&L investment profit, investing activity, investment category. So if, for example, you have made the transaction, listen carefully, bank debit, rental income from investment property credit, and that parked to the P&L at investment category. Number one. Number two, is that particular rental income affect to the operating profit? No. No. It's not affect to the operating profit. So do we need to make adjustment for cash flow? No. But with IS 1, other income may include this type of incomes, rental incomes, where that previously the adjustment was required, but not now. That's a point. I have shared an example, rental from investment property. But here the example, depreciation of investment property if they use cost model. First, let it be clear. Depreciation of investment property. This depreciation expense, it's not the part of operating category. This depreciation expense is a part of investment property. First of all, don't refer the IS 7 cash flow. First, clear the P&L. If you invest as in investment property, it's if Toyota invests with the investment property or some property declared as investment property, it's not the part of core business operation. Any rental income, any capital gain, Any depreciation, it's not a part of operating activity. It's clear. So it's all the depreciation, all the rental income, any gains that's parked to P&L but to investment category. But we here now connect with the I7. We have started the cash flow from operating activity from operating profit. So from that particular investment property depreciation not affected to the operating profit. So that means we need to make no need to make for cash flow any adjustment. It's no need to withdraw. Same case, third one first. Sorry, depreciation done, third one. Share of profit or loss of associate. Listen carefully. Associate profit losses by equity accounting. It's parked to P&L, parked to investment category, not affect to the operating profit. So no adjustment required for cash flow. Same case, gain loss on financial instrument when investing in financial instrument is not a main business activity. When investing in financial instrument is not a main business activity, means not a main business activity means it's not a bank. It's not a bank. Leave it bank. Toyota invest in shares. The Department of Treasury invest in other company shares or bonds in the market and getting the returns, interest income or dividend income. That's automatically in P&L park to the investment category. So if it's already part of the investment category, here you are working with the cash flow where you need to adjust your operating profit for making adjustment for the cash flows. No need to adjust any gain or loss of the financial instrument investment returns, gain, losses, anything else. It's tricky, but I hope it's clear. Now, example, read it carefully. What that the three changes. Sum up for the cash flow. Number one, the very simple number one, cash flow start from the cash flow from operating activity. Very first is operating profit. That's standard. That's standard. This one. Start with operating profit. Close with cash flow from, sorry, the cash generated from operations, replace, it's no more with the name of cash flow from operating activity before income taxes. And then incorporate the taxes, and then the final is net cash flow from operating activity. Previously, here you can work out for finance payment, interest payment, dividend payment also option, but it's no more. So straight start with operating profit, then make all non-cash adjustment or fair value adjustment if it's possible, like this, if possible. Working capital adjustment, identify cash flow from operating activity, income taxes paid, that's identified net cash flow from operating activity. First one. So first one is about the change of name. Second one, quickly, second one. What the second one? Interest and dividend paid received. Normally Toyota, other than banks, all these things. Interest received, dividend received, investing activity. Interest paid, dividend paid, finance activity. Exception about the banks and asset management companies. Non-cash item, be careful. These things are not affect to the non-cash items. Are no need to make adjustment from the operating profit. Now, practice question. Practice. You have to make practice. Practice question. Read it. Small case. It's a small case. Oblong reports the following. Operating profit 600,000. Operating profit. Depreciation on investment property 50,000. Cost model. The point is that depreciation investment property cost model 50,000. Is that effect to the P&L previously or the main P&L? No, it's already parked to the investing category. So if we are working with the cash flow, do we need to make any adjustment for the operating profit? No. No cash, non-cash item. Share of profit associate 30,000 gain on financial instruments. Two things, non-cash items. Share of profit associate and gain on financial instrument. Okay. Prepare cash flow from operating activity in direct method. Quickly. Prepare, it's about explain. Cash flow from operating activity before income tax starts with operating profit 600,000. Exam point of view, you will get 1 mark. Depreciation investment property measure under the cost model not included in operating adjustment because it's not related to operating category. Straight. Non-cash item, share of profit from associate 30,000, gain on financial instrument 20,000 when investment is not the main activity. Also excluded from adjustment. So the final cash from operating activity is calculated after making only the relevant adjustment to the operating profit. That's about the cash flow. That is about the cash flow. So this is about the video related to the group accounts and the cash flow matters. If you have any confusion, you can ask me anytime. Thank you very much. Take care a lot. Bye-bye.